It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today we're going to talk about taxes. Now, I know most people have probably already filed their taxes. 2020 strikes again. We get the extension until May 15th for most people. But traditionally speaking, we're past what would be considered the normal tax season, April 15th and all that. And the reason I want to kind of discuss it is, well, based on everything that's going on politically and everything else we have with our situation with our country, it looks very likely that this might be the last year that we'll have the tax rates, that we've been dealing with over the past several years. It's possible, certainly, we could see another year of it. Depends on how long it takes the current administration to pass their tax law changes that they're proposing. But given everything that they're talking about, what they want to do, they certainly have, they have the votes. We'll put it that way. They have the majority, obviously, although very slim, they do have it. So if taxes are going to increase in the future, which overwhelmingly looks probable. We'll put it that way, overwhelmingly probable that we'll have a higher tax rates in the future. What can we do to help offset that? Obviously, higher taxes means if you earn income or get a profit or investments or anything, you keep less. I mean, it kind of boils down to that. Now, there's a lot of factors that go into it. I mean, that's the simple version. The factors that go into it, of course, is we have a progressive tax system. In other words, the higher your income, the greater the amount of tax you pay. So it's a graduated scale. So if somebody says they're in a 25% bracket or 33% bracket or 15% bracket, whatever it may be, not all of your income, of course, is taxed at that rate. Based on last year, it's hard to judge what's going to happen year to year going forward. But based on last year, the first $24,000 of earned income for a married couple, for example, was the standard deduction. Whatever the standard deduction is, and there always is one. Just to do a quick review on taxes. Those that you already understand this, great. Most people don't. But if you have a standard deduction, that means whatever that is, $12,000, $24,000. If you're a married couple, it could change next year. We'll see. But that means the first $24,000, for example, the standard deduction amount is in essence tax-free income. That's income you earn. And again, that's on earned income. We're going to talk about the differences on that in a minute. You don't pay any tax on that. And then current brackets, the first bracket is at 10%, and roughly the first $10,000 after the standard deduction is taxed at 10%, and then so on. So it's a graduated scale. So to make it simple, and these are round numbers, roughing based off of 2020 tax numbers, just so you know, if you're a married couple filing jointly, you had and you took the standard deduction, then you had the first $24,000 of earned income was essentially tax-free. You had a deduction, offset it. The next $10,000 roughly was taxed at 10%. Okay, so you paid about $1,000, a little less than that, of the next $10,000 of income. So in other words, if you made $34,000, for example, you'd pay about $1,000 in income tax. Okay, and that's if you had no other deductions and kept it real simple. And then each level that you go above that, bracket-wise, then each income bracket higher gets taxed at a higher rate. So the first bit of income is not taxed at all because of the deduction, standard deduction. The next batch, the first bracket at 10%, and so on. And that's how it's pretty much always been. So whatever the brackets are in the future that could change, that'll impact things. And two, it's not only the bracket rates that make a difference, but it's where they fall. So in other words, at what income level are you at that you then move to the next bracket? Okay? So there's two ways that the federal government, Congress, whatever, IRS can adjust the tax rules and increase someone's taxes. Okay, they can increase the bracket, interest rate, or whatever, not really interest rate, but the tax rate, I should say. They could lower the limits to, instead of making 60,000, for example, that you're at this rate, maybe it's at 50,000 and higher, for example. So there's a number of different ways they can play with it, so to speak. And of course, the other way is deductions. There's all kinds of deductions out there, like the child credits and mortgage interest deductions and all kinds of different things that most people get. Now, on that note, here's another little side note that I found surprisingly few people have realized, but since the 2018 tax law change, which was done with the Trump administration, by increasing the standard deduction to $12,000 for singles and $24,000 for married couples, about 95%, that's what the IRS states, take the standard deduction of tax filers. What does that mean? Well, there's the standard deduction, and then there's itemized deductions. Now, if you take the standard deduction, you file the standard simple form, the easy form, basically, the 1040 easy. And if you itemize your deductions, then you do the long form, basically, as it's called. Now, how do you determine which one you should file? Well, it's pretty simple. If your itemized deductions are more than your standard deduction, again, based on 2020, $12,000 for individual, $24,000 for a couple, then you would itemize. So really, it's the threshold. Is your standard deduction higher, or is the itemized deductions higher? Now, again, the IRS has determined approximately 95% of Americans who file taxes are filing the easy form and taking the standard deduction. What does that mean? It means you're not deducting your mortgage interest. You only get to deduct your mortgage interest, and this is, again, something most people I've run into are not aware of. You only get to deduct your mortgage interest if you itemize your deductions. And you're only going to itemize if your itemized deductions total are more than what the standard deduction is. See, if we go back in time a bit, there was some discussion at that time, I don't know if you remember, about there was some talk about eliminating the mortgage deduction. It got close to happening, actually, but it was rather unpopular because it's been a very popular deduction for quite a long time, and it's probably the primary deduction the average American gets. Probably the biggest one, frankly. One of the biggest, certainly. So instead of eliminating the deduction, they just increased the standard deduction, which in effect kind of almost eliminated it. In other words, the other limit was if you have over $1 million mortgage. And again, I'm not a CPA or tax person, so don't quote me on some of these things. I'm giving you rough estimates. If you want the details, by all means, contact a tax advisor. But this is the general stuff, obviously. Over $1 million mortgages, you're not able to deduct the interest above that. So when you limit the size of the mortgage, the low interest rate environment we're in, and the standard deduction where it's at, 95% of people don't have enough interest, mortgage interest, to get over the standard deduction amount. So what a lot of people don't realize today is they're taking the standard deduction, but they're not getting a mortgage interest deduction. Now, they're probably getting actually a better, overall, many times, same or is similar or even maybe better, more deduction than they were getting with the mortgage interest deduction. Why is that so important? Well, I still hear it today from a lot of folks. They'll say, well, I want to buy a house or I want to buy a bigger house or this or that because I want to get that mortgage interest deduction. And I have to ask them a question. Well, do you file the short form or the long form? Do you itemize your deductions or you take the standard? And most of the time, like I said, 95% of the time, according to the IRS, folks are taking the standard. So I say, well, don't purchase a house or increase the size of mortgage or house because of the mortgage deduction because you're not taking it. So something that's important to know, okay? I kind of got off track there a little bit, but my point I want to drive at is taxes are a constantly moving target. It's something that adjusts and changes quite frequently. And when Congress makes changes to the tax rules, of course, big changes occur. And, of course, the IRS makes thousands of changes, literally, on average, per year to the tax code. So it's one of those things that's it's hard to pinpoint all the time, particularly when you start looking forward multiple years. What's the taxes rates going to be? How are they going to impact me or you? You see what I'm saying? But here's the one thing I say, the big picture thing I can say off the top is it certainly appears from all indications that taxes will be higher in general on most Americans. Most Americans certainly who earn income and file, because I understand what they're saying. I'm hearing what they're saying politically about no one over $400,000 or $200,000 income will pay more tax. But that's not necessarily true. We all know politicians say things, and that's all parties. That's not political. That's all of them. They say things that sound good, and then when we get to the nitty-gritty and the bottom line, again, they could play with the brackets. They could play with the thresholds for the brackets. They can adjust various deductions, the standard deduction, all those kinds of things, the child tax credits, all kinds of things that are out there that could make a big difference. Why is this so important? Well, if this is indeed the last year of lower tax rates for a while, looking at options that grow money tax-free become even more important. And this is the Your Personal Bank show, and one of the biggest and most common reasons folks look into Your Personal Bank, simply put, is you can grow money tax-free, income tax-free. You can access it income tax-free, and you can pass it on to your heirs income tax-free. Now, of course, it has to be set up properly and all that, which of course we do, and we advise and recommend on how to do it. And frankly, it's quite easy, okay? But my point is, here's a bucket, here's a source of funds that are not subject to all this tax gyrations that we very likely are looking at here in the near future. And again, if there is an increase in taxes, that's going to impact how much you get to keep. And it will particularly impact things like retirement accounts, IRAs, 401ks, 403bs, 457 plans, all those types of accounts. Because those are accounts that defer the taxes to the future, typically. In other words, you're kicking the can down the road. You're not paying the tax now, but then pay it later. And the big question that needs to be asked, and I share this all the time with folks, is should you pay tax on the seed or the harvest? I'm going to encourage you to stay tuned to the next segment because we're going to talk about that very subject. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank show with Ference Toth.
Welcome back to the Your Personal Bank show, and today we're talking about one of the most popular or most common questions I get and most popular discussion topics I have shared now for years, literally, whether it's in workshops, on the radio. I have to laugh. I remember one day, it was a couple years ago, I was walking down I was getting ready to board a plane, go to a workshop, and a guy I knew who'd been listening to the show, he said, I heard your thing on the seed taxes and the seed and the harvest. It was awesome. I loved it. I tell everybody about that. I appreciate that. It's really resonating with folks. And again, the question is really this. Everything being equal, is it better to pay taxes on the seed or the harvest? Well, that answer is fairly easy. The problem, and I'll share with you, it's quite simple. Should you pay tax on the seed or the harvest? When we look at the situations, when we look at people's lives, we look at the brackets they're in, what they're doing, and the statistics show that generally, most of the time, it makes more sense to pay taxes on the seed rather than the harvest. Why? It's really quite simple. Would you rather pay taxes on a small amount of money or a much larger amount of money? The seed, of course, is the contribution. If you take a typical qualified plan, an IRA, 401k, for example, you're deferring the taxes now, and you're doing your contributions now without paying any tax. Your seed, you're contributing the seed. The goal is, of course, obviously, over time, is that seed, that contribution grows over time, And then when you're typically in retirement, now accessing those funds to supplement retirement, you're withdrawing monies from the harvest, right? Now, and of course, at that point is when you pay the tax. Here's where things get a little challenging. The question is the harvest bigger than the seed? Well, in most cases, that's the case, yes. And that's the goal, obviously. I mean, if it wasn't, they certainly wouldn't want to do that. So you are paying taxes on a bigger pile of money, more dollars, right? So you're paying more taxes overall. But the other issue, and this is where the counterpoint, this is the point counterpoint kind of thing. The other point that people will say to me is, well, if I defer the taxes now, I don't pay that, I can use that money, that tax money, and I can grow more of my money and have more later and then pay tax on it. Okay, that may or may not be true. One, there's a certain level of risk involved, typically, with most investments. Are you going to have more or not? Or how much more is an unknown. We'll put it that way. Certainly is an unknown. But I think the bigger issue is this. What's the tax rate going to be when you do access the funds? What is the tax rate going to be on the harvest, in other words? See, when I said earlier, everything being equal, should you pay tax on the seed or the harvest? In most cases, it makes sense to pay tax on the seed and let it grow tax-free and then access it later. And that's why Roth IRAs are quite popular, typically. You're paying taxes now to let it grow tax-free for life. Okay, that's the plan. The problem is the IRS strictly limits how much you can put into Roth IRAs annually, for example. So one of the jokes I always tell people is, look, if the IRS restricts something or limits how much you can do, probably means it's a pretty good thing for you, the individual, isn't it? And most people understand that and agree. Here's the reality. The question really comes down, though, and the reality is, are the tax rates going to be the same now versus later? Are the tax rates on the seed and the harvest going to be the same? Well, here's the real answer. The true answer is no one knows. It's impossible to determine what your tax rate's going to be on the harvest when you withdraw the funds, because no one knows what tax rates are going to be next. No one knows what tax rates are going to be next year, much less 5 years, 10, 20, 30 years or more from now, right? So for one, it's absolutely impossible to determine. So there's a level of risk involved with that, or what we call tax risk, unfunded tax risk. So if you're investing the money, say in the traditional IRA, 401k, whatever, and it's in the markets, for example, which most people, that's where the funds are, or some people do self-directed IRAs, and they invest in things like real estate or precious metals and things like that, Bitcoins, cryptos, those kind of things. There's certainly a level of risk with all those types of investments, aren't there? I don't think anyone would argue that fact. So it's an unknown. Certainly, you want it to be a larger amount. The more time you have, obviously, the more likelihood, statistically, you're going to have more money. But there is an unknown level. There's a risk there. Okay, so there's an unknown. Secondly, you don't know the tax rates when you do access those funds, so that's a second level or a second unknown. Now, here's where it causes some challenges. Again, because you don't know what the tax rate is going to be, it causes a couple of problems. One, how much is your IRA or 401k really worth to you? You see, I do this all the time with folks, and they'll show me statements where they've got their IRA or 401k, and they got $100,000 or $500,000 or $1 million or more, whatever, in this account. And that's great. They've worked hard, they've contributed to it, they've invested wisely, the money's grown, all that good stuff. But and someone should be proud of that fact because they've done a good job. But one of the things I point out all the time is, if you took this money out all at once, for example, by the way, if you in most cases today now, with stretch IRAs gone and everything else, unless that comes back in the new laws, which I seriously doubt, honestly, because our government needs money. Okay, they spend a lot and they want more, right? Let's be real. If you pass away, your heirs are going to get there's going to be a lump sum tax hit. And it can easily be a third if it's a sizable, any kind of sizable account, IRA, 401k. can easily looking at a third or more of that money gone. That's just federal, not including state tax. So if that's the case, if you have $1 million IRA, for example, it's really worth to your heirs when you're gone, not $1 million, but something like probably $600,000-700,000, give or take, maybe less, right? If you take it out over time, what's the tax on that? Well, certainly there's taxes there, and that depends on your income and your brackets and all those kinds of things. But if tax rates go higher in the future, then obviously the amount you get to keep is less, isn't it? And again, it's an unknown. And even a small incremental change in the tax rates or brackets can make massive differences on the amount that's actually yours to keep or yours to use and live on. Okay? So that is a second issue with the seed or the harvest in terms of what's the tax rate going to be down the road? And we just don't know, do we? So my point is simple. If you want to take that unknown tax risk off the table, you want some money in a tax-free type of account, not subject to the income taxes. And again, that's where Your Personal Bank comes in. Contact me at yourpersonalbank.com for more information. I'm not saying necessarily all of your money should be tax-free, but what I am saying is to have a portion of it there at least just makes an awful lot of sense. Because if you have a bucket of money that's not subject to taxes, and of course you have a bucket that is, well, do you have options when it comes time to taking the money out in terms of how much you take from each bucket, therefore affecting how much in tax you actually pay? In fact, we use that. It's called bracketology is the term we use. And it's a very effective way of minimizing the taxes on your IRAs, 401ks, or whatnot on the harvest in retirement so you have more to keep and use and live on. Stay tuned in the next segment. We're going to talk about that further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're talking about one of the most commonly asked questions I get all the time, and that is, should you pay tax on the seed or the harvest? And the reason I get that question so often is, well, one of the major benefits of Your Personal Bank is you can grow your money income tax-free, access it income tax-free, and pass it on to your heirs income tax-free. Now, again, it has to be set up properly to do that, but it's quite easy to do so, and we, of course, help people make sure that happens. And I've been sharing this idea for years, literally, should you pay tax on the seed or the harvest? One of the main reasons I ask the question always is very few people I run into have actually asked or analyzed that question. In other words, they just take it on face value that deferring your taxes now, kicking the can down the road, so to speak, is the way to go, because so many people do IRAs and 401ks and those kinds of things. Interestingly, those that have looked into or maybe have done Roth IRAs have probably done that analysis. In other words, I should say, not someone who contributes to a Roth IRA, but someone who does a Roth conversion has done that analysis. And what is that analysis? It's really what you're doing is you're looking at traditional IRAs and Roth IRAs work the opposite in terms of taxes. Your Personal Bank fits in with the Roth IRAs in terms of how they're handled tax-wise. In other words, traditional IRAs and 401ks, you defer the tax now. You do not pay tax on the money now, the contributions, and then you pay it on the distribution when you access the money later, typically in retirement. Therefore, you're paying tax on the harvest rather than the seed. You're paying taxes on when you take it out rather than when you put it in. Roth IRAs and Your Personal Bank policies work completely the opposite. You pay the taxes now up front on your income, so you're paying tax on the seed. But then the money grows tax-free for the rest of your life and access and spend and use tax-free. So that's paying tax on the seed, not the harvest. Now, again, why? And in the last segment, if you missed it, I'm going to encourage you to go to yourpersonalbank.com, check out the previous segments or shows anytime you like, pass it on. I go into more depth on it. But the bottom line is, typically, in most cases, paying tax on the seed makes more sense. We've run the math, run the examples with so many different clients over the years, over the decades, literally, that it makes sense because the bottom line is you're paying tax on a much smaller amount of money, typically. Would you rather pay taxes on a small amount or a much larger pile of money? Okay. Secondly, what are the tax rates going to be today versus down the road? Given our government debt and what our current administration is saying about taxes, it seems extremely likely that taxes will be higher in the future. Therefore, you're going to be paying a higher rate probably of tax on a much larger amount of money. Okay? When you start to think about it that way, those things start making less and less sense. Okay? Again, it's an unknown. It's impossible to know what the future tax rates are going to be, but it certainly looks like they're going to be higher. Okay? And then the last thing about it is when you create a bucket of money that's not subject to income tax in the future, what you've done is you've created yourself options. You've opened up another whole world of options that could benefit you tremendously down the road in terms of how much you would have to live on or supplement retirement. Okay? So what do I mean by that? Well, the term that tax attorneys like to use is called bracketology. Now, I'm going to say right now, I'm not a tax attorney or a tax advisor, and then you want to know the details on how all this works, I highly recommend contacting a qualified attorney or tax advisor. But I've just seen it from so many situations with clients and recommending them to tax folks and them running the numbers and seeing the results that bracketology is a really, really smart way to go in terms of determining how much in tax you pay year to year, particularly when you start withdrawing the funds. Here's what I mean. So let's assume for a minute you've done this. You've set up a personal bank policy or a Roth Ira, that type of thing, in addition to having traditional IRA 401k monies. Let's assume you have two buckets of money. They don't need to be equal, but let's just assume both have a significant amount of money to be able to accomplish these goals. Here's the thing. When it's time to start taking money out, let's say to supplement retirement or any reason for that matter, depending on your income and your tax bracket at that time and whatever the rate happens to be, let's assume you take a certain amount out and based on your income or whatever at that time, it's going to push you over a limit, okay? And it's change brackets. In other words, you're going to pay a higher rate on those extra dollars. And again, the amounts that we're talking about can be quite significant. Many times, not only, I'm not talking hundreds, but even thousands of dollars difference per year, okay? Well, what if instead of pulling that extra amount out of the IRA or 401k, what if you could pull those monies out from a tax-free type of account? Would you lower your bracket? Would you lower your overall tax liability? The answer is yes. Stay tuned in the next segment. I'm going to discuss this even further and show you how you can really take control of your money and taxes in the future. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're rounding this up today, and today our subject is really, should you pay tax on the seed or the harvest? We've been talking a lot about it. I know most people have probably pretty much wrapped up their taxes for the year, and I know some folks don't want to think about it. Hey, that's behind me, or soon to be behind you, and you just want to move on. But those who do a little bit of tax planning for next year, and the sooner you do that, actually, the more effective and more efficient you can do it. You can actually really reduce your taxes potentially next year and every year thereafter by implementing a few simple strategies. Again, most people just go along with life and just, fund their IRAs or 401ks or whatever because that's what they think they're supposed to do, or that's what they're told to do, and never really think much about the future tax consequences. See, part of the problem with deferring your tax is, well, you're kicking the can down the road, aren't you? And, our federal government's famous for that. And, financially, that can cause a lot of problems for an individual. We don't have the ability to print money our way or raise taxes to get our way out of it, do we? The thing is, we have to be a little bit more financially responsible. That's a good word. The bottom line is, a little bit of planning ahead can go a long way. What is it? An ounce of prevention is better than a pound of cure. I can't tell you, and that's why I'm sharing this, because, we're just wrapping up tax season. It got extended this year, but I can't tell you how many times over the years, literally over the decades, that I've worked with folks, and now they're nearing or into retirement, and they're starting to access monies or looking to access monies from their IRAs or 401ks. And unfortunately for them, they poured most, if not all, of their resources for retirement into their traditional IRA or 401k. The problem that causes is, in our industry, it's called a ticking tax time bomb. Okay? In other words, by deferring the taxes to later, sounds great now. Sounds great on the short run. But down the road, now you end up paying sometimes huge amount of taxes. And folks end up with a lot less money to live on than they originally anticipated. The second issue about that, of course, is by deferring the tax to the future is, well, the reality is you have no idea what the tax rate's going to be in the future, do you? It's impossible to determine that. And given our current political situation and the amount of money the federal government has spent, the Biden administration is openly discussing raising taxes. So it sure seems highly likely the taxes are going to be higher in the future, aren't they? So if you deferred them now at, frankly, what's a historically low rate, folks, forget the politics. The math is simple. We're in one of the lowest income tax environments in history. What if you were to reposition some of those taxable funds at a time when tax rates are low from a taxable account to a tax-free account? Can that be done? And the answer is yes, absolutely. There's multiple ways of doing it, but it has to be done. It has to be calculated and done properly. In other words, you have to run the numbers and determine what makes sense, what income bracket you're at, and all those kinds of things. What's your taxing bracket and such. Roth Conversions, for example, are a very popular option where people determine that continuing their IRA, their traditional IRA or 401k, is less advantageous than converting to a Roth, which means they pay the tax now and let it grow tax-free for the rest of their life. You can use your personal bank in the same type of method where you determine that you want to create a income tax-free bucket of money, which just makes a lot of sense. And the reason's quite simple. If you have two options rather than being stuck with just one, like I see so often, where you just end up having to pay the tax that whatever the tax bracket is, whatever the rate is, you end up stuck paying it. What if, again, you had an option where you had two buckets of money? You had a relatively decent amount of money in each bucket. One's taxable, one's not. Can you then decide each year, for example, based on your income and based on the current tax situation, can you then decide how much to withdraw from each bucket and then basically determine how much tax you pay each year? Or keep yourself below a certain bracket level, for example, therefore saving yourself hundreds, if not thousands, of dollars in taxes each year. See, I see that, and I see it all the time. I work with clients all the time in that. Of course, we work in conjunction with their tax advisors to get the exact detailed numbers. But the general picture, I think you understand the general idea. The general idea here is really quite simple. Give yourself options. Take back control of some of your money. Here's the thing. And I talk about this all the time, IRAs and 401ks and such, I'm not saying not to do them. They can be a great tool, but they can be overused. And I see them very often overused, frankly, where, again, people pour most, if not all, of their eggs in one basket, so to speak. And the problem that incurs is limits your options down the road and very likely increases the amount of tax you're going to end up paying down the road, especially if tax rates do go up in the future, which seems extremely likely, doesn't it? So you see, my point is what I'm trying to get at. Now, how do we go about, let's say somebody has some taxable accounts, some IRA, 401k monies and things like that. How do we go about helping alleviate some of that tax liability down the road? Okay. Well, now I'm going to generalize here. I mean, I can't say specifically what would make the most sense for you because, frankly, we got to look at your numbers. We've got to look at your income, your tax, we got to look at your tax returns, that kind of stuff. See what kind of taxes you are paying, all that kind of stuff, and what kind of accounts you have in various things. But I can give you a general idea of how it's addressed, and we can determine if it makes sense for you. Like I said, contact me at yourpersonalbank.com. Be happy to go through that little exercise with you. It doesn't take long. It's just determine if this makes sense for you. Frankly, I found in most cases, I'm going to tell you, in the vast majority of cases, it makes a lot of sense. Okay? And again, if you think tax rates are going to be higher in the future, then it starts to make a ton of sense. Okay? So, first of all, if somebody's currently contributing to an IRA or a 401k, and I run into this quite often, one of the things, of course, if you get a 401k and you company match, you typically want to take the company match because, as I point out to folks, that's free money. I mean, it is, but it isn't. I mean, it's kind of a misnomer. It's extra money. It's actually extra compensation to you. So let's say, for example, you contributed, $5,000 a year into your IRA. Okay, and the company's matching that, so they're contributing $5,000 a year. So $10,000 a year is going into your IRA, or I should say your 401k. Okay, that $5,000 the company put in for you, that's part of it's not really free money. It's actually compensation. Now, I know a lot of you won't have this option, but some of you will, particularly with smaller companies. Do you have to take the extra $5,000 a year, that match? Do you have to take it in the form of a 401k match? In other words, could you ask HR or the owner of the company, if it's a small enough business or whatever, could you ask for them to instead just pay that to you in payroll? Would that be an option for some people? And well, the answer is yes, of course it is. Would the company really care? Frankly, from a financial standpoint, it shouldn't. If the company gives you $5,000 a year in compensation, either in pay or in a 401k, they get the same deduction. So it's not really financially, should not make any difference really to speak of for the company. Now, they may be, they have policies in place, or it's just too complicated to address, and they don't want to deal with it. But my point is, it financially shouldn't, frankly, make any difference to the company, and particularly smaller, closely held companies. This can be done. Now, why would you want to take the extra compensation and pay now rather than, say, adding it to doing a company match in your 401k? I mean, wouldn't you pay the tax on that extra income now? The answer is yes, of course you would. But then what if you took that money and then funded it into a tax-free account like your personal bank and let it grow tax-free for the rest of your life? Would you have more money? The statistics show in most cases the answer is yes. And if tax rates are higher in the future, most definitely. You see my point. The second thing is, what if you're not contributing to one? Oh, by the way, if you're still contributing to one, what you're doing is, again, you're building a ticking tax time bomb, is what's called in our industry. So the point is, stop building the bomb. Look, if you're contributing to an IRA and it's just yours, or you're self-employed and there's no match or whatever, or there's a 401k without match, oftentimes it makes a lot of sense to stop the contributions and instead start funding a tax-free account like your personal bank. Again, keep whatever you have, it's there. You have that bucket, let it grow, let it do its thing. You're going to pay tax on it down the road. That's understood. But at least you're creating a second bucket, a tax-free bucket now, which will then give you options down the road. A lot of people do that, and that makes a lot of sense. And the beauty is, with your personal bank versus the Roth IRA, twofold, is you don't have the restrictions on how much you contribute, like you do with the Roth. For your personal bank, you don't. And secondly, the Roth IRA is created by Congress. Your personal bank is not. It's a private contract. So Congress can make changes to the Roth IRA anytime they want to. I mean, they created it, right? They make changes to the tax code all the time. So they could easily change the rules or make it become taxable again. I mean, I'm not saying they're going to do that, but there's nothing stopping them either. So you fall under the government system again. What I'm trying to help you do is, if you're contributing into the qualified plan system, the IRA, 401k, Roth system, that's the government system. Now, if you trust our federal government to take care of you and not cause negative changes to your money, to your retirement, you trust that they're not going to mess with you, fine, keep doing that. But if you lack confidence that the government is going to do the best, what's in your best interest, I'll put it that way, then you might want to start peeling some money away or peeling some away from that, or redirecting, I should say, to a private source, something you control that's a contract, rather than being part of the government retirement system, as I call it, or the government qualified plan system. The Congress created it, folks. Congress controls it, can change it, and they do all the time. So again, sometimes it's about taxes, yes, and eliminating future tax liabilities or reducing that, but it's also about gaining control back of your money, or at least some of it, and giving yourself options so that down the road, irregardless of what the tax scenario is, you have options of which bucket to pull from. And you can determine or reduce the overall tax liability year to year and save hundreds, if not thousands of dollars every year. That's what it's really about, okay? So now, if you already, point, what if you have an IRA, 401k, whatever, a traditional one, you're not contributing anymore, can you reduce your future tax liability? And the answer is yes, it depends. Again, we'd have to look at your situation, but in essence, we would be looking at something that would be similar to a Roth conversion in terms of, does it make sense to keep it where it's at and have to pay taxes as you take it out? Or does it make more sense to strategically redistribute a portion of it each year, being strategic about this, minimizing the overall tax liability, to build a tax-free bucket of money and therefore give yourself more control over your retirement dollars, irregardless of what the tax situation or the tax liabilities are in the future? Again, it's about taking back more control of your money, peeling back some of the money from the government system and the government tax rates, and gaining more control and more options on your money. That's what it's about, folks. Take back control of your life and your money and your retirement. Contact me at your personal bank for more information. I'll be happy to go through this little exercise with you to see what makes sense for you. And as always, stay tuned to the Your Personal Bank show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.